Welcome, everybody. Thank you for tuning in. We have another one of our Gold Leaf webinar series here today, and I hope it'll be informative and valuable for all our clients. With me today, we've got the firm founders, Michael Brina, Diego Favero, and myself, Ryan Hunter, one of the portfolio managers, and Eric Lafortune, one of the senior investment advisors here. We wanted to keep our, clients informed always on what's going on in the market. So we thought we'd take some time after, there's been a little bit of volatility coming through lately, after a very tranquil year post tariff liberation day in April and an unusually kind of calm fall. We have seen a little bit of jitters in the market. So we thought we'd, give our clients our take on what we're seeing and how things are developing and what opportunities we see out there, and just keep the clients informed, keep you guys informed on what's going on. So I guess I'll start around the room on what we're seeing in particular. We have seen a pullback on the S&P, as of, this morning is just under 4%, but some stocks have come off and, volatility's come up. So what's really driving this volatility? Well, I want to get your thoughts on that.
Yeah, I can jump in to start off with. I think the uncertainty around the U.S. Fed decision for December is probably one of the biggest catalysts going on right now. And we went from probably 2-3 weeks ago, 100% rate cut, to last week maybe a 25 to 30% rate cut. And as of this morning, I think we're somewhere around 60 to 70. I could be a little bit off on my numbers, but I think that's probably been the biggest catalyst that we've seen so far, and it's created, like you said, some of that uncertainty. And we were really forecasting, August and September to be softer months and potential consolidation occurring there. And we really didn't see it, and so it's not a terrible surprise to see it happen in November here. I think, from my perspective and the things that we've talked about within the group, the U.S. Fed decision is probably one of the biggest obstacles that we're seeing right now.
Yeah, if I can add to that a little bit. I mean, about 3 weeks ago, we had the longest shutdown on record in the U.S., and I think that really triggered some of this volatility and uncertainty in the market. And then, of course, we have a market where valuations are elevated. I would not saying that they're all-time high, but we do have elevated valuations on certain names in certain sectors in the U.S. And when you have a little bit of uncertainty, you do see people pull money and capital out of those names. And I think that's what we've been seeing for the last little bit. And then Diego's point, the Fed and the uncertainty around that.
Yeah, I'll just add. Oh, go ahead. I was going to add, we got to look. April, we had the lows. And from April until really October 31st, I mean, the markets went straight up, and it's healthy for the markets to have some consolidation. I mean, so we've seen that in the month of November. We actually had a lot of cash in our portfolios. And for those who you look on a regular basis, you'll see that we actually have been adding to the markets as throughout the last 2 or 3 weeks. So we have been buyers. We still think the markets have a lot of upside between now and the end of the year with volatility. But we definitely see some positive signs. I mean, one thing I will share is that I don't personally see any recession. I think the guys here would all agree as well. And so if you thought there was a recession coming, if rates were going down because of that, then I think, we'd be a little bit worried, but we've been a buyer of this marketplace.
Yeah, I think to the group's point, the shutdown and the Fed are kind of going hand in hand, and that the Fed and that's all the market doesn't have all the data that it usually has going into to make these decisions. A lot of the U.S. job numbers and inflation numbers have been delayed, so the market doesn't really know what to expect in terms of the what the whole picture of the economy is looking like right now in the short run. The data we have had has been positive, but some have been calling for the Fed to be cautious because of that, and that's why. So what Diego was saying, you've seen a whipsaw in what the market is expecting, sort of in that first December cut. So yeah, also to Mike's point, we've had, the S&P was up over 30% from the April lows. So it is, healthy to see a little bit of consolidation. And And I think, one of the drivers obviously of this market has been the AI theme. And I think you are hearing people start to doubt that a little bit. Um, just wanted to, if you wanted to touch on, what we're seeing on the opportunities and some of the risks on the AI side.
Talk to that a little bit. So, we've already seen a lot of companies come out and actually commit to spending massive amounts of money, right? So we're seeing, the big tech companies out there committing hundreds of billions of dollars. There are estimates that potentially in the next 5 years, there could be up to call it $9 trillion in spending in this space. Now that's on the high end, but anything between $5 and $9 trillion. And the big winners there are the chip designers, the chip builders, the cloud computing company, and the energy sector actually. So we still like that theme. We like that investment idea, and those are the types of names that we're buying in our portfolios and continue to buy into their portfolios.
Yeah, to add to that a little bit, you got a stock like Broadcom that's up significantly today. Google's up. These are NVIDIA's sort of best around, but certainly leads that space of artificial intelligence and is a key player. So we've definitely participated in AI is one of our major themes, and certainly feel that we're maybe a third of the way through this cycle, and it's going to be a big driver going forward.
We saw Nvidia report earnings last week, and sort of a much anticipated report. On the quarter they were $54 billion in revenue, up 63% year over year. So a lot of the talk is, are we in Nasdaq 99 or 2000, where things are in a bubble, and if things have gone crazy, you know when you have earnings growing at 63% year over year, and in those kinds of numbers, there's still a third to half the valuation. You look at, the Amazons, the Nvidias, they're not even close to where, Cisco was the sort of the poster child for, the bubble back in the early 2000s. So we're not even approaching that level. And there's still a pretty big runway, in terms of the build out. To Eric's point, companies have committed, significant amounts of money. Nvidia said in their call they have, $500 billion basically on the books, or demand that they can see in the next couple of years, in terms of chips, which is just massive. So is there questions that some of the subscale players, the smaller players, there's too much hype around them, and some of the stocks have gone up? I think there's always going to be a little bit of that talk, but you're seeing some of that consolidation. But the quality players, with great balance sheets and can use those cash flows to invest, is where we want to stay. The Nvidias, the Googles, whose Gemini model, their new model has come out and is, been widely reviewed as, on the cutting edge, in some cases better than ChatGPT. So there's already more competition and innovation going on in the space. So yeah, on the fundamental story on the equities, I think 84% of companies beat the last during earnings season. So we've had a healthy earnings season, and again, that fundamental anchor in the market is still there. So there's some other things on the wall of worry. I mean, aside from Fed policy, what else is are you guys looking at in terms of the wall of worry on what's on your radar for the now and the end of the year?
Did you want to jump in?
Go ahead. I'm just hearing now is I think the sentiment is a little scary. I think a lot of people are a little worried about what's going to happen over the next couple of weeks, especially with the interest rate cuts or not. I agree with you, Diego. The probabilities are now positive, and that more likely we'll have a cut moving forward. But I think the AI bubble, which I don't think, and I think all of us would agree here, that we're definitely not in the AI bubble. So, and there's no recession. The word recession came up just the other day. I read in a report, and I mean, Vesta just spoke the other day and said, I don't see a recession, and he was very bullish on 2026. So, We're starting to get some data now, even talking about 2026 and what people are anticipating to happen in 2026. So I look at it this way. We own some of the best companies in the world, bar none. You look at the profitability, and Brian just mentioned it. I mean, 84% of all companies that reported during earnings season, which we just finished, have beaten their expected numbers. So, I mean, the fundamentals are there. I'm very bullish. I still think over the next little while, will there be volatility? This is part of the process, right? I mean, you take 2 steps forward, 1 step back. And when you see a pullback like you see now, typically what I see is we get higher highs. And that excites me. So I get a little more bullish and excited about these little pullbacks. And it wasn't that big. I mean, at the end of the day, the S&P dropped about 5%, which normally means stocks could vary between 10 and 20% drop. But those are buying opportunities. And I think we were well positioned to be able to take advantage of those opportunities. So I like where we're at right now. I like where we're heading, and even today's marketplace, like Diego, you mentioned Broadcom, it's up 10%. I mean, the Nasdaq's up 2.65, before we started this meeting, just in one day. So there will be momentum. There will be some profit taken at some point in time as well. But I still believe that the fundamentals are there, and the worry is the media worry. I mean, for those who watch, the news on a regular basis, they tend to overplay what happens. So part of the ability to stop listening to the noise is really crucial in our business. If you listen to noise, you won't sleep well, and you'll panic, you'll make bad decisions. So it's the ability to basically get rid of the noise, focus on the companies that you have, look at the fundamentals, look at the balance sheets, look at the projections moving forward. If those are all in place, then you can sleep well at night. Eric, you and I were talking, was it Friday? And you said, how did you sleep? I said, I slept like a baby. So, I mean, as long as you have good stocks, good companies that are growing, you shouldn't have to worry. There will be pullbacks. But again, as long as you don't need the money tomorrow, these markets will go up. And today is a good example of it. Today will be a green day based on what we're seeing. So,
Hopefully it doesn't change when we're talking, right? So, um, some historical data. I think over the last 100 or so years, we've had uh, 10 double-digit returns heading into November with a down year, a down month in November. Every one of those 10 years, we saw positive certain returns in December. So just, history doesn't always repeat itself, but it's a pretty good indication of what we've seen in the past. And a lot of times it will repeat. So we're certainly very optimistic for December. We often talk about a Christmas rally. We may see that sooner. And so hopefully Friday and today are good examples of what the market will be doing, in the foreseeable future here. So yes.
What do they say, Diego? I fell high.
You are seeing, sentiment, you see the headlines, you see the uncertainty around the data, and sentiment gets washed out in the short term, and you have, people who are leveraged and people making, going into companies or, investments that aren't, quite so sound. And then, they get flushed out in these types of markets and create opportunities for the long-term holders, I think. So I would agree with that 100%.
But yeah, so to add to what Diego said, I mean, I think, Diego, that's the information that Ren had provided us this morning.
Yeah. Yeah.
Yeah. So we look at probabilities. What are the probabilities that markets will go up? What are the probabilities that markets will go down? And based on that information that we were able to discuss this morning, the probability is that we're probably going to move upwards in the month of December. And so, that's how you got to look at these things. Again, buying quality companies, but then again, looking probabilities and using them to your advantage.
I think you're going to see a bit of the rest of the market participate outside. I know we talk about AI and semiconductors a lot, but I think you'll see a lot of the other sectors of the market participate as well. I mean, a name we've held, Carnival Cruises, they had record net income for the year and the best bookings they've ever had. JP Morgan, had one of their best quarters ever trading in investment banking. So I think other parts of the market are participating too. We're not just, holding the Magnificent Seven or, just technology. I think there's other parts of the market that'll really start to drive things as well and get a little bit more broader participation.
Yeah, to your point, Ryan, even Caterpillar, right, which is a name we've owned for a while, it's up, call it 55% year to date. And that's sort of a low technology type business, right?
Yeah, exactly. I mean, it seems everything is somewhat tied to the AI trade in that, the amount of construction for the data centers has been massive. But all said, I don't think any of this change in sentiment really changes, our outlook for the year end or into the early parts of the new year. I think, we still believe that there's upside in this market. We still think the fundamentals are there. Um, and any dip we see, we're gonna be leaning into and buy.
And Ryan, I mean, I know your job is to make sure that we stay on the path. I mean, if you look at this year, we have done well. I mean, I think there was a study done not that long ago saying that about 80% of all portfolio managers are underperforming their benchmarks. If you look at our portfolio, that's not the case. And so we worked hard in April when we had the drop in April. We made the right decision where we bought, not sold. We identified there would not be a recession, and we saw the benefits of it. You saw the benefits of it at the end of the day. We did build up cash late August, early September, and we started buying quite a bit. And I think there's a little bit of cash left, but not an awful lot left over. But now we're seeing the bounce. So I mean, still think very bullish between now and the end of the year. Think that there will be more likely a probability of an upside from where we are as of today. So, Eric, do you want to talk about bonds a little bit? Maybe we normally don't talk about bonds, but it would be nice to maybe give everybody a little bit of a flavor of what's going on in the bond market as well.
Yeah, well, bond market's been both exciting and very boring at the same time, right? So we've actually seen front end yields move downwards, right? So with interest rates moving lower in the U.S. and expectations for lower rates, we've actually seen the front end of the curve move lower. So that's overnight to 2 year, 5 year. Um, and so basically, when yields move lower, you actually have prices move higher. So for those of you that have a lot of bonds in your portfolio, the conservative, balanced portfolios, they've performed well on the bond side, correct? So Ryan, remind me on some of the bond holdings we have on a total return basis. We're probably in around that 5.5 to 6% this year.
Yeah, that's where our fixed income holdings have been. We've been, conservatively positioned on the bond side. We have stayed in near term bonds. We don't want to take a lot of interest rate risk, and we haven't taken a lot of credit risk. We had, increased it kind of again in that April time period and then brought it back. You know, we still feel we can get low to mid single digit returns on the fixed income side. We're we're conservatively positioned right now, but we've had a great year on the bond side as well. One thing that's in the headlines that we've talked about quite a bit is this private credit. Sort of the scare around, is there going to be a credit event? And I don't know what your thoughts, Eric, but we've largely avoided we've completely avoided the private credit market, but credit markets in general, we definitely reduced a lot of our exposure. That is a risk, but I'd like to get your thoughts on that too.
Yeah, no, I agree. And this is, this type of paper was never something that I liked personally. A lot of receivables in that private credit that, are junk, quite frankly. This was never a space that we're interested in. We just thought you didn't get paid for the kind of risk that you were taking, right? So a lot of this private paper, you probably get 8, 10, 12% some of this stuff, but that's not enough. And I think we're seeing it now. There's just sort of, potentially an upcoming event in this space. And luckily we've completely, moved away from that, and we just didn't see it as safe. So we didn't buy any.
Yeah, I think the transparency, private credit's called private credit for a reason. You don't really know what you're buying or what you're invested in. And again, we've talked about it as a group. It's hard to believe, there's supposedly safer, credit-worthy borrowers, borrowing at 12 to 15%. There has to be some risk in there that, it's not being advertised or not being disclosed properly. So we've avoided that. And even on the bond side, on the yields, the U.S. is still, they're issuing a lot of debt. We don't see it as an issue in terms of, sustainability for now, but the long, end of the bond yield curve, or the longer dated bonds, continue to go up. So we've stayed short term to sort of avoid that, interest rate risk, and, avoid all the sort of fiscal problems that not just the U.S., but, Canada, Europe, and the developed world seem to have.
Yeah. And when I said, things are really boring in the bond market, that's exactly it, right? So we're basically staying very short in terms of maturity dates on our portfolio. Uh, our credit quality is very high. And that's because we're not seeing the opportunities and we're just not getting paid to take that risk, right? So we're not doing it. And then when we do see those opportunities, we'll definitely be out there extending out credit and extending out duration.
Does everyone want to talk about where they see interest rates over the next 12 months in Canada, the US? And also maybe your thoughts on the US Canadian dollar. We have a lot of clients who go to the US on a regular basis for snowbirds. I don't know if you guys feel comfortable in just bringing that up to maybe share that a little bit as well.
Right. I'll take the risk part, the interest rate risk if you want the interest rate, if you want to talk currencies. So in terms of rates, I think in Canada, we're probably close to being finished. Maybe we have another one next year. But we were ahead of the US in terms of interest rates moving lower. So I think we're almost there. We're almost done. In the US, we likely have we're hoping probably another one before the end of the year and another three next year, right? So probably a full percent move next year is what we're expecting.
Yeah, that's what the market's pricing in right now. Again, that's been those expectations have been changed. You're changing by the minute. But overall, the trend for the next 12 months, is definitely lower. You're seeing, a US 10-year bond, sort of the gauge where, a lot of people look at in the bond market is just over 4% now. It was closer to 5 at the start of the year. So you've seen a lot of that expectations of rates coming down come into the market. I agree with Eric. I think Bank of Canada is probably done, unless economic conditions get a lot worse. We've cut 4 times, I believe, this year. The Bank of Canada 3 or 4 times already. And while the U.S. has only cut a few, so we're much ahead. And that's the year started out, to comment on the currency, where the Canadian dollar got a lot stronger, and over the past 6 weeks it's gotten weaker. So it's almost a wash for the year, but as the Fed, continues to cut in the US and Canada stays stable-ish, you should see that currency, the loonie, get a little bit stronger. But probably, I personally don't see a major move in the currency on the horizon. If anything, you could see a little bit of loonie strength into next year. But I assume it'll be range bound in this $1.40 sort of range. I don't know what your thoughts are.
No, I think you're right. As we see contraction in interest rates, right? The stronger the country where it sees interest rates compressing is usually where you start seeing weakness. So potentially we're going to see some Canadian dollar strength there into the year, but a lot of that's already priced in, right? So unless we see a surprise, so more aggressive Fed cut, which I don't expect. I mean, inflation was a problem just a year ago, right? So inflation's still top of mind with a lot of the central bankers. So I think they'd rather err on not enough cuts than too much cuts at this point because of inflation.
So, Roy, we're getting close to 30 minutes. Anything else you want to talk about, or do you want to go around the table? And
Yeah, I guess maybe we'll go around the table on what takeaways do you want to have clients for year end? I know you've talked or touched on it a little bit, Mike, but I guess what would the message to our clients be for the end of the year?
I think, again, as long as the right quality companies, and if they continue to grow, which we just saw the reports, stay bullish till the end of the year, stay the course. Because I still think we're going to end up to very strong. I do want to, maybe before I pass it on, I do want to let everyone know we are starting getting ready to put our 2026 playbook together. And we spend quite a bit of time talking to a lot of our associates across North America, not just in Canada, but in the US as well. And we usually put a game plan in place. So I would think by the 15th or 20th or so of December, we'll have a game plan, what we think is going to occur in 2026. Remember next year will be a midterm election in the US, so that usually increases volatility. But I think once we have that playbook or a game plan for 2026, maybe we'll do another video in January to bring you guys up to date what we see potentially happening, and understanding that we have the ability to make any modifications throughout the year, but to make sure we're ready to go, so you can see, is a risk on or risk off for 2026.
just to add to a couple things Mike said, we are optimistic for the balance of the year. We like potentially how this thing will finish off. One of the things that we're looking at right now from a tax perspective is we're looking at whether we can find some losses to take advantage of some tax loss harvesting. Fortunately, we've had a pretty good year, and there's limited opportunities. But that's one of the things that we're looking at within our portfolios to provide some creative tax advantages that will help our clients out on their non-registered pools. So it's something that is front and center, and we're looking at actively right now as we enter into December. So again, optimistic, hoping for positive returns in December, but also looking at how do we get tax efficient for our clients and their non-registered accounts.
Eric,
And for me,
odd.
yeah, for me, it's just looking into next year, right? Like we're already end of November now. We have Thanksgiving this week. Markets early close on Wednesday. Markets closed on Thursday in the US. So there's really only a few weeks of trading that's left into the year, right? So, I'm looking into next year already. I think Mike touched on this a little bit more volatility next year, the midterm election. But, my thoughts there is I think you have an executive that is looking to push a certain policy, and he's going to want to win the House and the Senate. And I think he's going to give up some of the goodies that we've been waiting for. And I think that's all going to be positive for us next year. So I'm very optimistic for next year.
Yeah, I think you have to, remain fully invested. I think this is not the time to, take risk off. I think, we've seen all the fundamental, information come in, and, everything remains strong. All the themes that we like, are AI, chugging along. So I think it will be positive into year end. And, that'll be one part of Gold Leaf's Christmas gift to our clients is our 2026 playbook into next year. So we'll have that ready for you, and we'll, obviously keep you always updated and informed on the market. We still think things are going to be strong, not only AI, but there's a lot of, exciting things out there that are just in the early innings. And if we have interest rates coming down, the economy remaining strong, and, our companies that we own continue to grow their earnings, we're going to be in good shape. So I guess just to wrap it up, thank you everybody for, tuning in and your time. A happy American Thanksgiving to you. And our team will be touching base with you before the holidays. So thank you for, tuning in and for all your support throughout the year.
Yeah, I agree.